I don't think the data's letting him hint that any one side of that, balance is more risky than the other at this point. So if I had to bet, Michael, my bet would be he toes the line, data dependent, risks on both sides. We don't know what we're going to do, but we'll continue to watch it as we go.
On Friday, Jerome Powell will have his most consequential speech at Jackson Hole. He's had some doozies. If you remember 3 years ago, he basically ripped up his speech and did a 5-minute pain is coming. This one's more important. As we sit here today, Tuesday, I only think there are two options. I think A, he comes out and relents and says basically the door is open for September rate cuts. Not guaranteeing it because we do have some more data, but I think there's possibility he opens the door. On the flip side, there's a possibility he will come out very hawkish and say, I don't know what you guys are talking about. There is no September rate cut coming. We've had horrible data. We got more coming, and maybe we'll do something in December, but guys, stop thinking September is coming. So Anna, I don't know where you come down on this, but I do think those are the only two options. If you see a third, I'd love to hear it. But Friday's speech with Jerome Powell is going to be important and market moving.
Yeah, and that's the question is, does he want the markets to move before they make their decision based on their data? Historically, the Fed has used Fed speak to give forward guidance, like they're trying to kind of set the markets up with the expectation of what they might do so that there's no shock to the system. Because if they don't kind of, play their cards a little bit and show, hey, this is what we might do, then if they do something the markets don't expect, it usually results in a tanking of the markets, at least to some extent for a few days. And so they do like to kind of plant stories and plant seeds to give them at least some idea of where they're going. And the question is, does Powell know where they're going or not? And so, I tend to think that the data is not bad enough on the employment and unemployment side yet to make them feel that is a greater risk yet than potential increase in tariffs that we're starting to see an uptick in. And so if he starts to give any kind of forward guidance that a rate cut might be coming in September because of some softening in the labor market, then that's going to set the markets up, in my opinion, for an expectation of the rate cuts going right back to the 80-90% chance of rate cuts that we had before the hotter than hoped for inflation print. And I think Powell's still fighting the last monster, which is getting the inflation call wrong. He doesn't want to, in my opinion, give them an expectation that he's going to be cutting rates in September if we still have this inflationary pressure and if tariffs could cause inflation to continue to go up in the coming months. And I think that it could. So I think he is going to most likely come out and be very much, we are data dependent. We're in a good place. We're in a balanced place to have a good ability to sit tight, see where tariffs come the next couple of months, see where labor goes the next couple of months. And we're well positioned for either scenario. And therefore, I cannot give you guidance of where we're going until we see a little more data. I think that that's his only viable option, even if he wants to hint as to where they might go. I don't think the data is letting him hint that any one side of that, balance is more risky than the other at this point. So if I had to bet, Michael, my bet would be he toes the line, data dependent, risks on both sides. We don't know what we're going to do, but we'll continue to watch it as we go.
Yeah. And I just checked as you were talking, the Fed Watch tool currently has the odds of a September rate cut down. It was at one point 100% that there would be a rate cut. And actually for a moment, a 6% chance of a 50. As of, 2 minutes ago, it was an 84% chance of a cut and 16 no cut. Mm-hmm. So I think it's going to be really interesting because I do think the market is kind of going into this set up for a September rate cut, i.e. 84%.
Yeah.
And from where I said, I think Powell is going to want to move that lower. That's kind of how I measure this, right? Powell does his shtick. He does Fed speak. He says a lot of words that mean very little. But I think he wants to move the odds of a rate cut down. I think
Right.
that's how
He
he's
doesn't
going
want
to
to move it
judge
up.
success.
That's for sure.
No, he does not want to move it up.
Mhm.
He doesn't. Yeah, the last thing he wants to do is look like he is bending the knee to Trump and giving him
Yes.
what he wants. That's not happening.
Right.
So again, I'm just playing this out with you. I think Powell's going to come out. I think he's going to lean hawkish. I really do.
Yeah.
I think again, it's only 3 days away. There's no data between then and now, except maybe one weekly on a day. And the data on inflation was, kind of worse. And the jobs data, again, nobody kind of trusts it, but it's not horrible, at least not horrible yet. So yeah, I think he's going to basically come in and say, the data doesn't warrant a September cut. We're here just in case. He'll say something like that for an out.
Yeah.
But I think he's going to come in and go, guys, focus on December, something like that.
Yeah, and I don't think he's even going to mention when. I think he's
just
had his
later
foot in his mouth calling a date and then not performing because of data changing. When he was basically giving forward guidance of rate cuts before, then they did cut a little bit, but he gave guidance that they might cut more, and then he held the line, and that created issues. So I don't think he wants to tip his hand either way. I agree with you. If he's going to lean one way, it might be more hawkish. The one thing that makes me think they'll stay balanced and not lean too hawkish is the fact that the leading economic indicators have turned 7 out of 10 are negative, and 2 of the 10 are like 0.5% positive, but they're getting worse. And this is 3 months in a row that the leading economic indicators are going recessionary, with 70 to close to 90% of them pointing toward a downturn, with the only exception, Michael, being the stock market. The stock market indicator is positive because it's so disconnected from the reality of the rest of the economic data. And so Powell knows that the big money knows these things because they're watching the conference board, they're watching the leading indicators, because they understand, as you and I've talked about so much on this channel, that economies go in cycles. And the question isn't, are we heading into recession-like conditions? It's where are we currently in the aggregate? Are we there yet? And the coincident indicators, which are real time, is what's kind of, the headline number for both employment, unemployment, and for inflation are real time. But they continue to say they're trying to be forward thinking. They're trying to see, where is the puck going? And these LEIs are indicating, Michael, that we're closer and closer and closer to that potential recession call. And I don't know if you saw in the news this week, but Mark Zandi came out and said, hey, we're not there yet technically with 2 quarters of negative GDP. But all of the underlying fundamentals, including a large uptick this year and this last month in corporate and small bankruptcies, back to pre-pandemic levels, and some further back to like 2009. When you look at the underlying data, it isn't as good as Powell wants to say in terms of that balance of risk. But I think we truly are kind of in this stagflation-like environment, Michael, that I've been warning about for a couple of years, where you really have both economic softening and inflation at the same time. And it is very, very difficult for central banks to get us out of that without either a deep recession or significant GDP growth. And Powell is not in control of whether we have recession or significant GDP growth. A lot of that is fiscal, meaning that it's coming from the government and government policies. And I would argue, and some would argue, that we're kind of in a fiscal dominant period where economic policy by our policymakers is more impactful on the economy now than rates actually are. And so the central banks kind of lost some control of the economy because its tools for rates are not as effective in a stagflation-like environment, because if they cut rates too soon, Michael, while inflation let's just say from tariffs is starting to uptick, there's going to be such exuberance in a period where there's already irrational exuberance in the stock market, right? Investors are investing like everything's great, that could cause people to come out and spend all the 20% that still have money on the sidelines, they'll spend, and that could cause inflation to go up. But if they raise rates in the heat of tariffs going up, which some are saying could happen, tariffs come in hot the next couple months, the Fed could raise rates, then that is going to put a slowdown and probably push us into that recession. So he has to be extremely careful, knowing that we are in a stagflation-like economy where either move the wrong way could make things worse, and knowing that even if he does a little bit of rate cuts, it's not going to make a big enough difference in a fiscally dominant economy. And so he knows all of that. He knows the smart money knows all of that. And so he has to be very, very careful what he says. And for that reason, I still think he comes back right down the middle, doesn't give anybody what they want to hear, and says, listen, the balance of risks is about the same. We're data dependent. We know the data is not great, but we have to toe the line until we see which one of these risks is worse than the other. And his hands are pretty tied. So I don't think he can be as hawkish as you want him to be. I don't think he can be as bearish as some want him to be. I think he's stuck. So we'll see. It'll be interesting to see what he says and what he does and where things go.
Yeah, where this is going to me is something you've been warning about probably for 18 months on this channel. I think probably sometime this year, we could be in the unfortunate circumstance where inflation is going up. Mark Zandi says it could hit 4%. So we'll just use that as a guess. And that the unemployment rate spikes to over 5%. That's going to put the Fed in a very uncomfortable position to basically pick which thing they want to battle, because they can't battle both.
Right. Not at the same time. Now, there are tools that they can use, yield curve control, which some people think, Treasury might actually move toward. Scott Bessent is more on that side. And you have to look at what's the most likely outcome. If you're dealing with monetary versus fiscal policy and which one's more dominant, I would argue that right now fiscal policy is becoming more dominant and more in control of where things are going. A big change in fiscal policy from the last administration to this administration. So if Trump gets his way, if Congress that is currently before midterm elections, more slightly, but still just enough leaning GOP, and the Treasury Secretary, Scott Bessent, are all calling for rate cuts, that indicates to you that those who are making the decisions on the fiscal side are trying to save us from going into deep recession. Even if we have a little bit more inflation, they're not minding the higher inflation. Their policies are showing they don't, because they're trying to push for the tariffs right now. Their hope is to the 3-3-3 plan of the government, get 3% growth, 3 million barrels a day more. Maybe I might be off on the number of barrels there, but also get the debt down by about 3% per year over time. That shows that their desire is to have more growth, and a recession will prevent that. And a recession could completely derail their plans, because they need growth. They need this, one big beautiful tax bill was created to stimulate spending and to get people to not be afraid of recession, to get people to spend money so that they can get the growth equation higher than inflation. So if fiscal policy wins, and right now I think fiscal policy is going to win out to make rate cuts not as important, whether we cut or not cut 25, 50 basis points. But that shows me that the government that's in control of fiscal policy is much more worried about going into a recession than they are fighting inflation. Whether Powell comes on the same side of that or not, I don't know. But I would still argue that Powell's pressure right now is to cut rates so that we don't have a deep recession. And even though he's worried about tariffs, and some would say that side is what he's going to work on, I think there's enough pressure building in the underlying economy, and it's more recession-like conditions becoming more and more evident, that if he has to cave one way or another, I think he might actually cut rates in September. And so to that point, he could come out and get a little softer if he's going to admit the softening in the economy. I just don't know that he's ready to do it just yet. So it'll be fun to see. But ultimately, I think rate cuts are coming. The question is just, is it September or is it December? Or do tariffs come in bad enough that we're all shocked to see a rate increase? I doubt it, but we'll see.
Jamie Dimon said there was a 40% chance of the next move being up, not down. He did say that a few weeks ago, but let's close on this topic. Again, nobody has a crystal ball, but we have 3 Fed meetings left, September, October, and December. How many rate cuts, if any, does Anna currently guess?
Given the balance of risks, I'd say 50 basis points. If Trump and Bessent got their way, it'd be 150 basis points. What do I hope for? 150, Michael. I've got multiple loans resetting in this next couple of months. So I'm hoping that we see the 150. I'm just not holding my breath. I'd say 50, maybe 75, unless tariffs really come in making inflation quite hot in the next month or two.
Yeah, I actually fear we get the 50, or even let's say we split the difference, we get 100, just like last year. We got 100. And rates go up. Mortgage rates go up. That's my fear.
I'm thankful, and that could very well happen. I'm thankful that I have, at this point, just in terms of the loans, that I am a commercial I'm heavily borrowed in commercial assets. So my rates will be driven by the short-term Fed funds rate more so than the 30-year. But for those, to your point, that are hoping, oh, the Fed cuts rates, that means a 30-year fixed mortgage is going to go down. It's all going to depend on the Treasury market, the U.S. debt situation, and how many foreign and domestic buyers are going to bite at bonds, or they're going to be afraid that that cut is going to cause more inflation, and therefore they demand a higher rate on their treasuries that make the mortgage rates go up. So anything is possible at this point. I think we are all learning that in real time, Michael.
All righty, folks, do me a favor. In the comments below, let me know how many cuts do you think we have this year? Are you in the camp with Anna of 50? Are you in with Donald Trump 150? Or maybe some of you, I know, I see you in my comments, you think the next move is up. Let me know in the comments below. Anna, where can they find you?
Great. You can find me here on this channel. You can find me at social media at Anna Kelly, REI Mom. And if you're interested in real estate and wealth coaching or consulting, you can find me at my website at AnnaKellyInvesting.com, where you can make an appointment.
Thank you so much.